Welcome back to the Deep Dive. Today we are digging into the General Mills Q2 fiscal year 2026 earnings call, which wrapped up on December 17th.
And our mission today is pretty laser focused. We need to figure out if this packaged food giant is, truly turning the corner.
It feels like a high stakes moment for them.
It really is. I mean, you've got this brutal operating environment. Consumers, especially in those lower and middle income brackets, are hunting for promotions.
And the S&P benefit disruption is still a major headwind for their core shopper,
A
right?
huge headwind. So yeah, this quarter was complicated.
Okay, let's unpack this. We're going to try and extract the core strategy, the key financial markers, and really the outlook. It's all about volume recovery for them. Did they stick the landing?
Well, they definitely delivered the beat that the market needed to see.
The headline numbers.
The headline numbers, right? They look strong against expectations. Net sales came in at $4.861 billion.
Which beat the street by about $81 million.
Exactly. And the adjusted EPS, which is the number management really wants you to focus on, was $1.10. That beat the consensus of $1.03.
So that's the beat that drove all the optimism.
Yeah.
But we have to give the year-over-year context, because if you just scratch the surface...
Oh, it's a very different story.
Revenue was down 7% compared to last year.
And that's critical. Adjusted EPS on a constant currency basis, so, stripping out currency swings, was down a pretty significant 21% year over year.
21%. And the GAAP EPS was even worse.
All right.
Much worse. It fell 45% to $2.78.
Hold on. A 45% drop sounds like a disaster. Can you just quickly remind us why everyone's looking at that adjusted number instead?
Sure. So the non-GAAP number gives you a cleaner look at core operations. The huge gap here comes from one-time charges related to their yogurt divestiture and the acquisition of Whitebridge pet brands.
So not core business.
Not core day-to-day business, no. Investors mostly accept focusing on the adjusted figure, but still, that 21% drop tells you profitability is a real struggle compared to a year ago. Okay, so we've got a beat against lowered expectations, but a pretty steep year-over-year decline. And yet the stock jumped, what is it, up 3.5%?
It was 3.47% on almost triple the normal volume.
So why the confidence?
Because the market saw the beat, plus the fact that they reaffirmed their full-year guidance. That combination signaled that the operational playbook is working. It's a turn-the-corner kind of story. They stabilized expectations.
So let's go deeper on that profit story then, because margin compression seems like the price they had to pay to get that volume.
It absolutely is. You saw profitability get squeezed across the board. Adjusted gross margin was 34.8%. That's a drop of 150 basis points.
And operating margin?
Down even more. It dropped to 17.4%, so down 290 basis points. That led to an adjusted operating profit of $848 million, which is down 20% constant currency.
So this wasn't an accident. This was a strategic choice to sacrifice margin to get volume back.
Exactly. This is the cost of recapturing share. And they did talk about how they plan to offset some of this. They cited their internal cost-cutting program, Holistic Margin Management, or HM.
Right, HMM. What does that mean in practical terms?
It's basically their long-term program for finding efficiencies everywhere. Supply chain, manufacturing, logistics. They're tracking another 5% in HMM savings this year.
So that's their internal defense against inflation.
It is, and they need it because base inflation is still sticky at around 3%, and now they have tariffs to deal with, which we'll get to.
Okay, so where did the sales actually come from? The core North America retail segment.
It was down, right.
It was. NAR is the giant, but it was down 13% to $2.883 billion.
Oof. So where was the growth?
The growth engines were clearly pet and international. Yeah. Pet sales hit $660 million, which is up a really robust 11%.
Up 11% is huge.
It is. And international was also strong, up 6% to $729 million.
And what about food service? It was down 8%, but they had this kind of confusing note about index pricing. Yeah, that needs a quick translation. Basically, some of their big contracts are tied to raw material costs. When those costs change, the contract price adjusts.
So the headline number looks worse than the actual demand.
Exactly. The underlying demand meant that segment would have grown 3% without those contract adjustments. The key takeaway is that volume was actually positive.
Okay, that makes sense. And that brings us to their core strategy in North America retail, this remarkability framework. They've been talking a lot about managing the price cliff.
Right. And price cliff management is really a psychological game.
Right.
It's that point where a shopper just says, nope, too expensive, I'll buy the store brand. So General Mills isn't just dumping discounts. They're being very strategic about placing promotions right under that cliff to make them feel like a great deal.
And it seems to be working. They said Over 90% of their pricing actions performed as well or even better than they modeled.
Which is just incredible execution. It shows they aren't just starting a price war. They see the competitive landscape as rational. This is about being smarter, not just cheaper.
And the proof is in the volume, right? Pounds grew.
Pounds grew, and this is the big one. The company is growing pound share in 8 of its top 10 categories in North America.
So they are actively taking shelf space from competitors.
They are. And you combine that smart pricing with a planned 25% increase in new product innovation this year. They're setting themselves up to win on both value and newness.
Okay, so while they're stabilizing the giant net airship, the real growth engine everyone's buzzing about is pet.
This is where the story gets really interesting, yeah. The Blue Buffalo portfolio, and specifically their new wet food launch, Love Made Fresh.
The numbers on that launch looked impressive.
They are. They're almost at their goal of 5,000 coolers in stores. And crucially, they've already hit about a 5% share with their earliest customers.
5% share already. Wow.
And the consumer ratings are 4.8 out of 5 stars. People love it.
That's just rapid adoption. It really taps into that whole pet humanization trend, where pet food is basically a premium grocery item now.
Absolutely. The pet business is perfectly positioned for that long-term trend, which always gets a high valuation multiple from investors.
But it's not all good news in the pet segment, is it?
No, not entirely. The Wilderness brand is lagging. Management admitted it needs a new strategy, new products, better in-store execution. The whole dog feeding category is just, it's complicated right now.
Complicated how?
Well, it continues to lag the overall pet segment, and there are 3 reasons for that. First, sales are shifting to e-commerce, which is harder to track.
Okay.
Second, there's a structural shift towards smaller dogs who just eat less. And third, you have consumers pulling back on discretionary things like wet dog food.
So where's the growth in pet then?
Cat feeding and treats are growing the fastest. It seems even when budgets are tight, people will still splurge on their cats.
Let's shift to the investor context, because this is where the engineering of the profit turn becomes really clear. The timing bridges for the rest of the year are critical.
This is crucial for understanding what's coming next. So first, costs. Base inflation is still around 3%, and now they're saying new tariffs will add another 1 to 2% headwind.
So costs are still going up. What about all the good news on wheat prices? Those have come down.
That won't help them this fiscal year. Those favorable costs won't hit their P&L until fiscal 2027.
Why the lag?
Because they lock in prices for major inputs 6 to 9 months in advance to get supply stability. So right now, they're still paying the high prices they locked in last spring.
Got it. No cost relief yet. So Q2 looked good, but part of that was just timing, right? They pulled some sales forward.
That's right. Management was very clear about that. Q2 benefited from shipment timing and NAR. Think of it like borrowing sales from the next quarter.
So they pulled Q3 orders into Q2.
Exactly. It boosted the Q2 volume numbers, but that benefit is going to unwind in the back half, specifically in Q3.
Which means Q3 is being set up to look intentionally messy.
Precisely. The scanner data, the Nielsen numbers we all watch, might look pretty rough for Q3 volume. This is going to be a drag on Q3 earnings. It's the classic earnings headwind swap.
So they're absorbing all the noise in Q3 to set the stage for a clean profit turn in Q4.
That is exactly what it looks like. And they told us how. Management expects profit to turn up sharply in Q4, aided by 2 very specific things: favorable trade timing and the 53rd week of the fiscal year.
And they put a number on that, didn't they?
They did. $100 million favorable tailwind from those 2 items combined.
$100 million. And they said that would account for about 30% of their Q4 profit growth. That's a highly engineered inflection point.
It is. But the key thing for the market was that despite all this noise, they reaffirmed their full-year guidance. They're holding the line. They're essentially saying, trust our map. The profit is coming. Just wait for Q4.
All right, that brings us to our not financial advice segment. Given everything we've said about the pet segment's growth, that 11% rate, Love Made Fresh gaining share so quickly, there's an argument that its value is being hidden.
It's absolutely being masked by the slower, margin-pressured North America retail business. The pet business is a fundamentally different animal, higher growth, higher margin, and it plays into that humanization narrative.
Exactly. So here's the outrageous but plausible trade idea. A reverse sum of the parts spin-off play.
The thesis being that the pet segment is trapped inside this food conglomerate, trading at a lower multiple than it deserves.
Right. So if you were to spin it off into, say, a theoretical pure play Petco, that standalone company would immediately command a huge premium valuation.
It would likely trade in line with other high-flying specialty pet stocks.
So the trade would be to go long a theoretical spun-off Petco equity and short the remaining legacy food business.
The bet is that the value unlocked from the pet spinoff would far outweigh any losses on the legacy side. It's a bet on unlocking hidden value through corporate surgery.
It's an aggressive idea,
Yeah.
but it highlights just how different those two businesses are in the eyes of investors.
It really does.
So to sum this all up for you, Q2 delivered a crucial beat. More importantly, it seems to confirm that their pricing strategy is working. They are driving volume momentum.
They've stabilized the volume ship, but, and this is a huge but, the actual profit inflection point is strategically delayed until Q4.
And it's heavily aided by that $100 million tailwind from the calendar and from trade timing.
They are managing the clock very, very carefully.
Which leaves us with a final provocative thought. If Q2 volume was helped by shipment timing and Q4 profit growth is getting a huge boost from non-operational items, is the underlying momentum truly stabilized? Is it organic?
Or is the company just engineering the turn for the fiscal year end?
And the only way you'll know for sure is to watch that Q3 Nielsen scanner data. Watch closely for the unwind they talked about. That will be the real test of their competitiveness heading into fiscal 2027.
Right. If volume holds up through that Q3 noise, then the strategy is a true success. If it dips hard, then the Q2 beat might have just been smoke and mirrors.
That's all the time we have for this deep dive. Thank you for sharing your sources with us.